The broadcast is
Good
now
morning, good
starting.
afternoon,
All
everyone
attendees
around the
are in
world. How's
listen-only
everyone is
mode.
doing this Monday afternoon? Good morning, everyone. Good afternoon, everyone. How's everyone is doing today? My name is Eric, and today we're gonna be performing a free seminar from Elliott Wave Analysis. We used to do this seminar once every month or 2 months, and the idea is to make traders around the world to get a view and an understanding on how we see and we forecast the market. Like I say, my name is Eric. I was the founder of Elliott Wave Forecast back in 2009, and we are a group of analysts that forecast 78 instruments around the market. We do it in different to most. Doesn't mean that we are perfect. Let's start with it. It doesn't mean that we are perfect, but it means that we see the market. Thank you, Thomas. Thank you, Andre. Thank you, Roman, everyone there. Good afternoon, all. So the way that we look at the market, like I say, is different to most. I always call our company, I call it like it is a company that get the best of both worlds, right? Both of you, most of you guys see the market in a way through fundamentals, right? We're gonna talk a lot about fundamentals today, and you guys see the market using impressions, right? Terms like impressions, non-farm payrolls, GDP, all the stuff. We don't pay attention to those things. It's straightforward. Our members understand and know that through the years, we has been able to forecast most of the turn in the market in a positive way, in a correct way, without knowing what is going to create at the end the turn of the market. This market, in our belief, is made by a few people, which they have a lot of money and they trade one way. And most of the rest of the traders, including us, including you guys, we are at the mercy of the market makers, as we call it. We don't use fundamentals. We use Elliott Wave, but not an orthodox way of Elliott Wave, like many traders do, like 1, 2, 3, 4, 5, ABC, no matter what. No, we correlate the market. We use distributions. We use blue boxes, which are areas in which both sides of the market agree into a reaction that goes into one side, right? Into one side reactions. We are not a trading signal service, right? Because we believe that a trader, the less that you trade, the better. We believe in efficiency. In other words, you need to be more efficient as a trader. You don't need to be a trader chasing every single swing in the market because it is impossible to get it right chasing every single swing. So that's who we are, right? So today's seminar is going to be interesting, right? Because most of you guys, the inflation issues, the supply chains broken is in the news. And many traders are worried about what's going to happen in the future, right? Is things going to get back to normal, or the inflation is going to be transitory, or it's going to be a high tech? These are those natures in which it's going to, according to the fundamental traders, it's going to affect the market. And the way we look at it is that I can prove it, and I'm going to prove it today, how everything can be seen through the charts without using the fundamental trade. Thomas, Armando, everyone there, right? everything can be seen through the charts without using or any type of fundamentals, right? So I want to be sure you guys, the seminar is gonna last, I guess, at least an hour and a half, and we're gonna be covering, I mean, topics. First, we're gonna explain to you guys what a we're gonna explain to you guys what inflation is, the type of inflations, and things of that nature. And then we're gonna take a stand in if it's gonna be just about to be over and everything's gonna get back to normal, or if it's gonna last a little bit longer. And how we're gonna make a third point, which is how everyone needs to kind of open your mind, right? And understand that everything can be seen through the charts, right? That everything can be seen to the charts, right? That's what I want you guys to understand completely today, right? After the session. Now, let's start with the first point here. Like I say, we're going to explain what is an inflation, the type of inflations, if it is transitory or structural. We're going to talk a little bit about the U.S., what the commodities, because every fundamental trader needs to do understand, every fundamental trader needs to do understand one thing, and they understand that they always relate without a doubt commodity higher related to inflation. And there is the reason, right? There is no question as that if oil goes higher, the price of gas goes higher. That's how it works, right? It's a domino effect. So we're gonna prove that. We're gonna understand. We're going to explain to you guys today our forecast, our view in those two topics, and what we are expecting at the end, right? So it's gonna be, like I say, it's gonna be interesting. I hope that at the end of the day, and my goal, it will be that you guys, my goal would be that you guys will get out of the seminar with a clear future, but also very important that you guys came out of the seminar with a set of mind in which you guys will understand that the fundamentals do not matter. That the fundamentals are something that if you trade fundamentals, you always gonna be chasing the market, because the trading based and fundamental is hard to anticipate. And I'm gonna give you that today, so you guys came out with that chart that yes, is good to, in some ways, is good to understand what an inflation and fundamentals is. I don't deny that. But if you purely gonna trade using fundamentals, I really don't think that you guys going to be able to be successful traders. That's my view, honestly. Like I say, I've been trading for a lot of times, right? I've been trading for a lot of times, and I'm very successful in trading, and I really do not use fundamental to create a company like I did, to be in a business for almost 14 years, to cover 78 instruments, and to have thousands and thousands of members. So if I don't use it and able to do the thing, it's in a critical thinking way. It is in a critical thinking way. It is clear. It is clear that is not needed. Everyone, it is clear that is not needed, right? Okay, so let's keep going here. The next is inflation. What is inflation? Type of inflation, transitory or structural inflations. Now, what is inflation overall? Inflation is sustained increase in general prices of goods and services. It's measured in a monthly or annual percent increase. As an inflation rate, every dollar that you own, buy a small percent of good and service. In other words, what it costs $100 in 2020, it can cost 105 in 2000. In 2000, it can cost 105 in 2001. That reflects a 5% inflation. It's clear, right? It's clear that the price of gas, it was at least $1 less a year ago than it is today. And the reason why is very simple. Less oil is very simple. More traveling, right? Put it this way, the travel industry kind of stopped in 2020. The price of oil dropped even below zero in the futures, even below zero. The production decreased. The inventory that it was there when they declined, it went away. And what is now? Very simple. More traveling, more demand from oil for gas, consequently, the price increase. If the producers do not increase enough to meet the demand, the price of oil increase, and consequently, right there, what happens? The price of gas go with it. It's very simple. That's what inflation is all about. It. I want to mention that you guys all can ask questions. Can ask questions, right? I want to, you guys can ask questions if you guys have questions about the seminar, right? About the topics. So that's what inflation is, right? Overall. Now, inflation, rate and cost. Then we have moderate inflation, galloping inflation, hyper demand inflation, push and cost push inflation. So technically, this detail what create the inflation and what are the types of inflations, right? And then we're going to have those answers later today, right? Now, a moderated inflation, also called a creeping inflation, reflects a single-digit annual increase, right? So everybody knows that things do not cost the same today that 20 years ago, right? But by nature, the price of gas has been increasing. That's clear. By nature, the gas price has been increasing over the years, right? Everyone, Thomas, Anders, Roman, Armando, Peter, it has increased. I mean, it goes like everything in the market. It goes up, it goes down. It goes up, it goes down. That's the way it goes. And that's how it is, right? That's the way it goes, and that's how it is, right? So that is eventually a moderated inflation, right? Now, a galloping inflation refers to the session of high inflation rate that leads to an increase in the general price level. Generally, the inflation is a double, triple digit and reflects the price in US servers, and is what it goes for 10 to 100% annual. That's a lot of increase. And the hyperinflation is, the name suggests, is something that goes very, very, putting this way, very high, very fast, and it creates an alarming increase in price, right? So these are the type of inflations, and we're gonna let you guys know eventually you need to, using critical thinking, say that what we have experienced over the last year is not a moderated inflation, right? And it is something that, in my view, is gonna be, in my view, is going to be there a either a galloping inflation or a hyperinflation, right? That's in my view, and we're gonna try to answer at the end. A demand pull inflation exists when an aggregate demand increase rapidly that the supply, like I explained earlier. You need more demand for something, but you are not able to keep up with the demand. In other words, for a given supply increase, in other words, more demanding the production, that create a demand pull inflation, which is in some ways a good inflation, right? Because if there is demand for something, that means that the product is good. That means that there are buyers for it. Now, a cost push inflation is when increase of producing or creating something increase, and consequently increase the cost of the product that you're buying. That can be, if you look at gas, gas is a product, right? Everyone agree with me? It's a product that is created out of oil. So if the cost of oil increase, the cost of gas increase. And consequently, that makes Thomas a cost push inflation, right? And a strong labor union force the wage price to go out. That leads to an increase in price on goods. Because remember what we explained at the beginning. Remember what we explained at the beginning. Everything is related to your buying capacity. Everything is related to the idea that everything is related to the idea of how much you can buy with a buck, right? How much $1 can get you. And that's what inflation is all about, like I explained at the beginning. Now, exactly, Andres. A year ago, a gallon, we buy gallons here in the States. You can have a combination of both, yes, Roman. A gallon of gas, a gallon of gas here, we pay around $2.40, $2.20. Now it's $3.40 in the States. So I guess that is the same for you. This is when it gets in what we are right now, right? I got another comment that says, so realistically, you can have a combination of both types of inflation. And I guess yes, Roman, I guess yes. Both can be happening at the same time. Now, a transitory inflation or an extraordinary inflation. Now, you're welcome, Roman. Now, everyone here, because I know that traders, eh, I hope that traders, I know that most of the traders, right, I know that most of traders follow fundamentals because for some reasons, which personally, I don't understand it. But at one moment, I was realistically one of you guys, right? At one moment, I was realistically one of you guys. I do recall the dates. At one moment, I was following, honestly, every single news event. I was following every single Fed release. At one moment, I was one of those, right? Uh, and and until one day that I figured it out that that doesn't matter, right? But I know you guys do follow still that process. Everyone has here the Fed saying that is a transitory inflation, right? Everyone knows or understands or has seen them mention the transitory inflation. Have you guys seen them mentioning the transitory inflation, right? The Fed. Everyone? Right. Somebody say that it's a lie. Me personally, I don't care, Flips, if it's a lie or no, right? Because at the end of the day, it doesn't matter. I'm gonna give you, like I say, my opinion at the end, and you draw your own conclusion. I'm not here to call anybody a liar. That's not my business. Now, transitory inflation is created by a temporary factor. I guess that the Fed, they see something that is reasonable, right? There always is inflation. Let's put it that way. Most of the time, there is inflation. But they see that COVID happens. And no question asked that the whole world, this is my thinking. I don't mean that is the Fed thinking. But I guess that they are more savvy than me, of course, when it comes to fundamental. I know an expert in this. But I guess that they look at it that let's assume, for example, that somebody produced the microchip that they use to do a lot of electronics, right? And you have a lot of orders, but you're producing more than the orders. So you have an inventory. When COVID hit in March of 2020, those factories, they were closed for 3, 4, 5 months sometimes. So the people that build the equipment, they also have an inventory. So the factory has an inventory, and the people that build the machines has an inventory. For a period of time, they were able to keep out producing after the reopening, right? And after the reopening, and they keep out producing. And the factory, when they open, they ship out the inventory that they already have. But there is a gap, right, created by COVID. And I believe the Fed, they believe that it's a transitory inflation because they see it in that way, that the gap created by COVID in production create the spike. I give you a simple example. I bought some electronics in May of this year. I had 4 items. One of the items, which is a microwave oven, it was supposed first to be delivered by July, then they move it by August, by October, by November, until they got to the point that they cancel the order because they cannot deliver it. So the Fed look at that and say there's gonna be a moment in which the factory gonna be able to, because if I was the owner of one of those factories, right, I would hire more people. I would hire more people to keep it out with the demand. That's what I would do, right? That's the way that I will operate. So that's what I think that they look at it that way. Now, if you look at the other concept, which is the structural inflation is an inflation that results from changes in the structure in demand and supply. This is more complex, right? This is like, for some reason, let's put it this way. The United States now, it put string regulations in things imported into the country, right? And they cannot be delivered anymore. So let's say that you are a fan, let's say, of Samsung, right? And South Korea cannot deliver anymore sanctions to the United States. So that creates something that breaks the regular flow of the economics, supply change, flow, right? And that's what is more structural, which is something that is going to be there to last, and that create the price increase. It's the same with the gas, right? If you look at it, if oil goes higher because there is demand and not the same level of production, technically that's a transitory until the oil producers increase the production. But if it comes the government and put taxes in top of the gas that you buy on a regular basis, that is there to stay. So that regulation to put tax on gas, that increase is an structural inflation. Why? Because you ain't gonna, unless you remove it, ain't gonna change. So that aspect is there to stay. That's the way that I see things, right? They ask me, I wonder if the Fed will raise tax in the interest rate. Honestly, honestly, I don't know. And like I say at the beginning, I'm not an expert. I'm not an expert in this fundamental stuff, interest. So I don't know, my friend. So that's the two types of inflation, right? Transitory or structures. Now, U.S. inflation, monthly inflation rate, CPI, PCI, core goods and services. Now, we're going to show you some charts right here. For example, this is the last 2 months inflation numbers, right? If you look at the difference, it has been 5% higher over the last year to year, for 1.2 to 6.2. And if you look at this chart, if you look at this chart, if you look at this chart right here, if you look at these charts right here, there is a spike. There is a spike here, right? Around the 1 year anniversary, around the 1 year anniversary of COVID, there is a spike right there, right? There is a spike. I believe, I mean, at least my common sense, I believe that if you use, let's think about it with me. If you look this in a spike, what it looks more like a transitory or an structure, the spike. My opinion is that it's a transitory, right? Why? Because it's human nature. It was transitory also in the 80s, right? At the beginning of the 80s. It has to do a little bit, I mean, you can deep into reasoning, and I believe it's gonna be, it's gonna be inflation, but it's gonna get to normal levels sometimes in the future, not tomorrow, not next year, but it get back to know where we are, because if you look at the charts, the history, it always trending higher, right? In the history of inflation, like I say, they always inflation. There are periods of, because if I want you guys to understand, right? Yes, price keep going higher. In 1991, 92, you pay $67 a gallon of gas in the U.S. 70 cents a gallon of gas. It went higher, then it put back. It went, I remember during 2008, 2009, a gallon of gas cost what it was costing now, about 3 something. Remember, Louis? 3 something, 350, 390. In Miami, at least, in Florida, it cost that. Then it went back, right? That's disinflation, right? You're getting more for your money. And then it went higher again. Because I remember very well, because I drive an SUV. An SUV is a V8, so gas, every time that I fill my tank, it was 98, $100. Then it will get back to 50. Now you get back to the hundreds. So it goes up and down, right? And so that's the way I see it. Now, if you look how the price, the consumer price, the personal consumption, they go together. The higher the price, the less you get for your money. Now, right here, we're showing what is the goods, how it has spiked because of COVID. Because that's what I think, honestly, that the Fed really see it as a transitory. Because remember, they know what it has changed, right? They know we have changed, right? What have changed? And they know, at least in my understanding, they know the regulations. They know what had changed, and they still believe that is that everything is because, honestly, because of COVID. That's what I really do think, right? That is because of, that's what they think. That's what I think is their thinking, right? Now let's keep going before, because I wanna explaining this so you guys are able to understand what I'm gonna show you now. This is not my expertise. My expertise is what is coming next. This is gold and the U.S. inflation since 1968. No question asked. It's the same side of the market, right, guys? Everyone, it is the same side of the market. Higher goes gold, higher goes the U.S. inflation. Beautiful, right? Beautiful, everyone. The relationship, right, Fix? Beautiful. Right there. Now, 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 higher inflation equal higher dollar. Why is dollar so high too? I don't know. Oh, the dollar is high today because your you're thinking right there. You're thinking right there is kind of the fundamental thinking, Andrew. Let's get to the next point. All right. So eventually here, the big question is the inflation a transitory or an structural inflation? Right? 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 And first, I'm going to show you in where we were previously to 2020. And if this inflation, in my view, is going to last a while, so it might be a structure, it might be transitory. I don't know. I'm not an expert. If it's going to last more. And the answer is yes, it's going to last more, right? And I'm going to show you guys some points, some charts from the back in those days, right? And back in those days, right? Back in those days, right? And how everything was foreseeable, right? Looking at the charts. All right. So remember, the first question that I want you guys to look at it and understand was this for a is this rise in inflation? If I was the Fed, I would avoid it, or is real because of COVID? So I'm gonna be a little bit sarcastic and say, is this really because of COVID, or COVID is the catalyst or the excuse that the market makers are using in order to justify the inevitable that is gonna happen no matter what. Sarcastic. If this is because of COVID or it's gonna happen no matter what, right? And then you guys draw your conclusion, right? My conclusions are real, right? My conclusions are real, right? That's the way I want it. Uh, uh, my conclusions is clear, is that everything is an excuse, Faith, right? That's the way I thinking, right? That's the way I thinking. All right. So let me show you some chart, right? For example, This is the chart of the SPY, right? This is a chart of the SPY, which is the S&P ETF, back in November and October of 2019, right? Right? And in October 2019. And eventually, right there, I want you guys to look at it there. How the S&P, we say to Elliott Wave Forecast members, is going to rise all the way to 3040. It's going to drop to 220. I do hope that you guys realize back then that we didn't know that COVID is going to happen, right? Everyone, we didn't know that COVID is going to happen. Now, guess what the S&P SPY did? SPY went from, if you look at the day, how many instruments do we cover? We cover 78 instruments in Elliott Wave Forecast on the daily basis. 78 instruments. Right? Now, this is the SPY. Right? Now, this chart right here that I'm showing you, it was October 3rd, 2019. October 3rd, 2019 was over here, more or less. Look at the right here. We say that it's gonna go to 440. We were over here, and it went to around 338, right? And then it dropped to 218. But we didn't know the pandemic is gonna happen, Andrex. That's the point, right? How do we knew that it's gonna be a tremendous decline from 340 to around 222? It went to 238 to 222, right? It went to 218. So, being sarcastic, I have to say, being sarcastic, a little bit of sarcastic, I have to say right here that we didn't knew back on November, October 2019, what is going to create the decline? Yeah, now you say it was created because of the COVID, but who knew that it's going to be a COVID, right? So the technical aspect of the trading is telling you what is coming. And the market makers, the people that makes the market, use the pandemic as an excuse to make the move. You see my point, Andres? Fix, Roman, everyone there? Everyone see my point? You agree, Rafael, right? Now, now, exactly, Roman, exactly. Very good, very good. It's not the news that move the market say zero. Agree. At the market make it, right? Now, I'm making this point about the SPY, and now we're gonna go to the commodity. For example, this is a, for example, let me look at this chart right here, right? This is our website. Most of you guys know it, otherwise you won't be here. And I'm telling you how everything is predictable if you look at the chart, right? For example, this is GCC, right? And GCC is a chart, it's a commodity index, right? And it's a commodity index, right? And it's a commodity that gather right there, that gather the price of commodities. I'm going to show you guys a blog back from 2000 and middle of around 2016, 2020, in which we were able to identify that GCC right here, it was in a blue box area, right? That GCC was in a blue box area here. No, this one. Right? Right here, the GCC was in the blue box area, right? So if we look at GCC there, right, this is back on 2000, March 2020. It hit the box on October and August 2020. So right there is easy to say, all right, commodities gonna rise. Commodities, the price of commodities are going to increase, right? For example, this is the blow from 2019. Let me see here, 1 second. And this is the chart of GCC here when it was back here, right? This is the same chart. So our members back then, they knew, our members knew back then that an increase in commodities is going to happen very soon. Everyone see the before. This is the before, right? Everyone see it there, right? Now, you see the word CHK right there. That's the before, and this is the after. Look at CHK right here. Right? And look at the rally from here. So we knew that it's going to happen, that it was a matter of time. And we knew that the moment that they reached the blue box, which is something that most of you guys have seen in social media, in our blogs, in YouTube, everywhere. It is something that we use to tell members when to enter the market. We don't trade unless the market is within a blue box. right? We don't trade unless the market is within a blue box. Everyone with me? Everyone understand the idea. We knew ahead of time, we knew ahead of time that the commodities are going to increase, right? We knew that because the commodity index was there. The commodity index was there already within our blue box area. The commodity index was already within our blue box area. Right? Now, that's how we see the market. I didn't know that the S&P, I knew that the SPY is going to drop. I didn't know the reason why. I knew that the commodity is going to rally. I didn't know the reason why. So these are charts, both this chart right here of the commodity index, right here. You see the commodity index. Look at the price of oil being forecasted highest to member. Look at the price of CSK being forecasted highest to member. And I want you guys to think yourself, honestly, what it has happened over the last, few, a year and a half ago. Exactly what we were able to forecast there in those two members, right? So when I look at this, like you guys, Roman and others have said there, I have to be sarcastic about if this market is real fundamental or is pure technical, or if this the money making the market or the money chasing the market. Is the money making the market? It's the market makers that make money here, right? And that's the reason why 90% of members or traders lose in this. Right? %90 of members, or traders lose over here. And the reason is very simple. It's because they're listening to too much noise, right? They're listening to news, to everything, and they're missing the whole point. That you are a little piece within a huge market, and guess what? You are a little piece within a huge market, and guess what? That you right there needs to trade as the market makers trade, or you're gonna be eaten by the market makers. That's the bottom line. So I honestly enjoy when I'm able in our live sessions. It's a game of chess, agree, but it's a game of chess that you better play. You better learn how to play. Otherwise, they're gonna take your money. Believe me. So we in Elliott Wave Forecast, we in Elliott Wave Forecast have learned how to play it, right? And we update our charts 4 times per day, right? We update our charts 4 times per day. Why? Because we believe that the market is dynamic, that we don't control it, but we don't trade 4 times a day. We trade when the market is within those blue boxes. Because the blue boxes, there is a science behind, which is that in the blue box, both sides of the market agree to a market reaction, either the bulls or the bears. Then that's when we enter and let the market decide. So everyone at this stage knows the path. How? We knew that the indices, they're gonna drop, but we didn't know what is gonna create the drop. Right? Everyone? Everyone understand that, right? Also, we knew that the commodities they're gonna rally, but we didn't know what is gonna be used to create the rally. CSK was trading at 191 back in June 2019. CSK right now is trading at 66. I know that there was some split and things, but it's trading, something did, but it's trading at 61. That's always the case, Raphael. Exactly, I agree with you. This is what Raphael is mentioning here. Glad that you have the same mentality as we do in Elliott Wave Forecast. Now, the path is clear. It was clear. Another one was silver, right? Look at the blue box back at the end of 2019. Look at the reaction, right? So the path is clear. So now, what is next is what is important, right? What is next is what is important. Correct, everyone? So, in my view, it's clear at this stage that the market, you can call the inflation. If you want to be a fundamental guy, you can make your own mind, right? You could call it transition or a structure, whatever. You can call it the way you are. But the charts don't lie. And like I showed you previously, when gold goes higher, what happens with inflation? It goes higher, right? Everyone? Higher gold, higher inflation. Right? Higher gold, higher inflation. That's the way it is. Higher gold, higher inflation. So we know that for the fact, right? Now they can justify, they can say whatever they say, but then you need to worry which side is gonna go gold, which side is gonna go oil, which side is gonna go everything, and don't worry about inflation. That's the whole point, right? So I'm gonna make my point. For example, this is silver right here. This is silver. It's bouncing from the equal X in 5 weeks, bouncing from the blue box in 5 weeks, right? Now, let me go and show the all-time cycle in silver. Now, this is silver back in 1997 at $4 an ounce. Silver back in 2020 at $11 an ounce. If I'm going to ask you guys, what is the trend of silver there? Higher or lower? Any guess? Roman, Fix, or you guys? It's bullish, right? All right, bingo. So silver has, and I remember myself, I remember myself telling our clients, right? Telling our clients to invest in silver back here, telling that something is going to happen. And I remember telling that the best way to pick a top in silver, exactly. You remember that, Phil, right? Exactly. To pay my daughter's med school. That's what I always say. Not to pay out my mortgage, to pay my daughter's med school. So silver is bullish. Now, I believe it's going to go to 55. Now, let's check some silver ETF. This is a silver ETF. It's trading within the blue box. So that's a warning. That's a warning because silver is trading within a blue box right there. So that is telling me right there, out of the blue, it's telling me you gotta be careful in silver. And when you combine the weekly bullish trend in silver with the daily trend right here in the putback of the silver ETF being of the blue box, the market might be telling you guys, that you should be ready, there for a possible renewal or higher silver and soon a market correction, because that's how it works. So when I look at silver yearly chart and the current stage, I have to be bullish silver. I'm not talking about the 1 hour charts. I hope you guys understand. I'm not talking about the 1 hour charts. Right? I'm not talking about the 1 hour charts. I'm talking about right there, not the 1 hour charts. These are the long trades that you need to have to answer your question. Is the inflation transitory or is structural? Or inflation is a fool, or you know why, right? I mean, it doesn't matter. It's going to happen no matter what, right? That's a question to be answered right here, right? Right? Now, this is the gold to silver ratio. When the gold to silver ratio trades lower, usually mean higher silver. usually mean higher silver. When the gold to silver ratio trade lower, usually mean higher silver. Right? Right? So when I look at this, the gold to silver ratio reacted lower from 318, which is the same low in silver here, 318, and it's showing a five-way impulse. It's going to continue lower, higher inflation, because it's higher commodity, higher silver. Now, we get back to here. This is silver. This is silver right here. This is silver right here. And what does silver have? What does silver have? Right here. It has a bullish sequence. I'm going to add right here gold to the equation. And gold is saying it's the same trend. Gold is the same trend. Right? Gold is the same trend there. Now, even worse, when I look at gold long time sequence, what do you think it is? It is bullish or bearish? Right there. Bullish. But there is something, like I say at the beginning, of the session, there is something that we do different than most. We don't use Elliott Wave. We don't use Elliott Wave the way that most people use Elliott Wave. As an example, Roman now. Roman say the trend on gold is bullish or an irregular flat. It cannot be an irregular flat. Yes, based in Elliott Wave, if you're looking at gold only, you can say, yes, it can be an irregular flat. That peak index here, you say 3, 3, and 5, right? If you look only at gold right there, right, Roman? But that's gold. That is gold. But the thing is that gold is not only gold. Gold is part of the whole market that trade, right, and relate to gold. And still, the silver is trading. Silver do not support a flat, because a flat in gold, it will be a tremendous strain in the dollar. It will be a tremendous strain, a weakness in commodities. And then silver, that will put silver right here below these levels. Silver doesn't look like a flat, like the gold do. It might be a flat. Those are the things that makes Elliott Wave not reliable by himself. There is no room, right? So that's how we use Elliott Wave. This way is how we use Elliott Wave, right? We use Elliott Wave in a way in which the count that we present, it needs to make sense, Roman. You understand? It needs to make sense because Elliott Wave always have what you want. If you want to be bearish, not the big picture. That scenario can happen in the 1 hour also. But you need to understand it. You need to understand what is happening. Does that make sense? You need to understand what is happening. Not only in the instrument that you like, but in the whole market. Now, this is another silver ETF, very similar to silver. This cycle ended. It's doing a flat from here. But look at the price. It's 10. You got equal. It looks like a flat from here, right? In the daily chart, it looks like a flat. And it got 1, 2, 3, 4, with one more low. Then it should rally and support the view that most commodities are showing, right? And support the view that most commodities they are showing. So we get back and we keep looking at it. This is a gold ETF, right? Besides, this is gold. And like I say, and I was saying that we use Elliott Wave. We use Elliott Wave in a different way. We create something that is called sequences to be able to forecast what is next. We create something that is called sequences. And this is a cycle from the all-time lows to 2011 to 2015. This is a new ball game. This is what we call a bullet sequence against these lows and against these lows. But silver is telling us that it's against these lows. Can I label an expanded flat as a WXY? When the X is a flat, that's what you mean? I guess that's what you mean. Right? Right? I guess that's what you mean. No, the expanded flat is a flat, 3, 3, and 5. A WXY is 3, 3, and 3. It cannot be labeled the same way. No. The whole move cannot be a WXY if it's a flat. So eventually, right here, the way I look at it is that gold has a bullet sequence, which is telling me that commodity is going to continue to rise. This is copper. All-time low, 1, 2, 3, 4, and 5. 2016, March 2020, new high. Another bullet sequence in gold, right? In copper. Another bullet sequence in copper, right there. Another bullet sequence in copper, right? Another bullet sequence there in copper. Another, which is telling me that it's going to continue to rise, right? Now, this is oil from March or April 2020, 1, 2, 3, 4, and 5, with divergences on the 5. an Elliott Wave after 5 weeks, in Elliott Wave after 5 weeks, what is happening? What is happening? In Elliott Wave after 5 weeks, what is happening? It happening that after 5 weeks, it comes 3, but after 3, guess what? It's gonna continue the same trend, right? After 3, it's going to continue the same trend. Right, guys? So gold is telling me that it's gonna continue to trade higher. Now, this is the future. It did below here and now rally, but that's the future. Now, this is an index from UK, the FTSE, right? The FTSE from UK, also with the bullet sequence. Most people believe in a wrong way, right? Most people believe in a wrong way that the indices needs to crash when commodity rally. And that's not the way. They use something that is called second dimension. Right? That's something that is called second dimension, in which they're gonna agree in swing direction, not in the overall direction. Right? So if you take a look at oil right here, or if you take a look at this commodity, at this index from UK, and you overlay the charts of gold, I want you guys to understand what is the trend in both of them, higher and lower. Higher and lower. Both are higher. So that means the highest commodities is lower indices is not there, right? It's not there. That's a myth. Maybe fix, maybe. That the dollar is gonna set off soon. So let's put in the conclusion here. We explain the type of inflation. We explain what inflation is, and on and on and on. Now, it's clear that we were able to see before the fact the decline in the indices. Yes or no? Answer your question. The decline on the indices. It's clear that we were able to see that back in 2019. Right? It's clear that we were able to see the rally in commodities ahead of time using the commodity index. We were and the blue box also and the blue box also on silver and the silver to gold ratio. The indices can trade sideways, Jason, yes, to allow commodities to rally. That's called second dimension in trading. right? That's called second dimension, right? So everyone understood that. Everyone understands our point. So our conclusion is that the index is going to continue to trade higher in more or less acceleration. Our conclusion is that we have enough data, 5 ways lower in the gold to silver ratio, a bullet sequence in gold, a bullet sequence in copper, which looking at silver, reaction from the blue box, looking at the silver ETF reaction or reaching the blue box, and looking also at, for example, this is a gold ETF, which is called Royal Gold, 1, 2, 1, 2, 1, 2. It can be an S, or the 1 can be here, and this is the 2. It's 5 swing. How many swing or wave do you guys see from the all-time low here to the peak here? How many swing you guys see there? 5, right? There is 5 swing. Right? 5 swing. Correct? Everyone see that, right? 5 swing. So that's bullish. That's telling you that gold is going to go higher. Right? So go higher. Right? Go higher. Right there means higher silver, means higher copper, means higher oil, means higher commodities. The indices, they can get in a wave 4, on a wave 2, and being sideways for a while when the acceleration happens in the commodities. Right? That's what you mean, right, Jonathan? Right? So it's easy, easy, it's easy to know, right? It's easy to know. Yeah, SD, a bullish commodities in the weekly chart. Yes, indeed. That's what we are expecting. Right? So it's easy to understand, getting back and looking at everything. It's easy to understand one thing, that the commodity long-term cycles, right? The commodities, the commodity long-term cycles are bullish. And then expecting higher commodity prices, that the commodity prices are related to inflation, that's a debate to be seen. Some fundamental traders believe they are. We are not fundamental traders. We are pure technicals. I don't care what the Fed talks. Members or all members know that I usually tell members what the reaction in the market will be before the Fed, right? Usually say that to the members. I don't care when there is non-farm payrolls. I don't pay attention to those things. So I don't pay attention to the inflation. If it's here to stay or it's gonna last longer. If you are a fundamental trader, you can say that based in commodities, if the commodities really mean that higher commodities is gonna increase inflation, then you can say that yes, the inflation, it won't go from transitory to any structure there, and it can last a little bit longer. But when I look at the indices and what they're showing, a bullish sequence on the FTSE, I can take and put back in the indices, which I believe is going to happen in 2022, or might already started. But it won't be nothing, it won't be a crash, because this is when people get loose in this, right? And this is something that I want you guys to understand, right? This is what I want you guys to understand. If you look at this chart right here that I'm showing you, right? This is a silver ETF, like I say here, right? What is the trend of that silver ETF? Bullish or bearish? Right? It's bullish. It has a low, a highest, and a lower high. That makes a bullish trend. Right? Right? That makes a bullish trend. Right? What is the trend of the S&P here? Bullish or bearish? And I want you guys to open your eyes. Both bullish, right? Now, no question that when the commodities put back here, the S&P accelerates. And that's how it works, right? But at the end of the day, my expectation is, and my conclusions are the same, that the commodity trend in the long time frame going to keep extending higher, and that the indices might get a little period of sideways in a correction, and that's when the acceleration in the commodities will happen. But the index looks like the nesting, which is telling me, after all, that the inflation is going to be a transitory inflation. And it is created by whatever the fundamentals say about the demand change, in that the moment that the commodities reach target from the e-collect of 2020, they're gonna start to get sideways. They're going to decelerate, and the index is going to rally, and the transitory inflation is gonna end. That's my 50 cents. But at least we're going to get another leg higher in these commodities, which it can be seen as a transitory inflation. That's my conclusions. I'm not an expert in fundamental, but I know what's going to happen. And it is seen very clear on the charts. Everyone with me? Any question overall? Everyone with me? Any questions overall? Everyone. Okay, a bunch of questions. I need to go one by one. I need to go one by one. Right? Okay, we're going to start answering questions from Thomas Down. Gold was in inflation age, but hasn't been so in Corona times. You think it come back? I guess that you mean that if gold is going to continue to, I think it's going to trade higher against everything. Honestly, I think it's going to continue to trade higher against everything. Right? Against everything. Right? That's the way I see it. Right? Let's see. There is hundreds of people here, so I have to go slow answering questions. Okay. What if the silver, you mean this is for Alusheri Ben, right? And assuming you're talking about the silver ETF here, right? I guess. Right? I guess. If silver ETF doesn't make the fifth way, doesn't matter. You should be long from here. Like I always say, we trade based not only in Elliott Wave, we trade based in high frequency trading. And these blue boxes are areas of high frequency traders. So everyone should be long already from that blue box and silver. Right? Let's keep with the questions. So you think the long run, the inflation is transitory? Jason, I believe yes. Not that it matters to me. It matters because my dollar is going to worth less. Put it that way. It matters because of that. But no as a trader. As a trader, it doesn't matter to me, Jason. I really do believe that the commodities are going to increase the price. They're going to continue higher. But, like I say, I know a fundamental trader. Right, Jason? I know a fundamental trader. So, but when I look at the indices, right, I believe that the indices, when I look at them, I believe that the indices ain't gonna crash. They're gonna correct, but it's a difference between a crash and a correction. And when I look at right here, when I look right here at the FTSE with a bullet sequence against 1999, also 5 weeks from 2009 to 2018, and it hasn't been able to break those highs, I believe that the index is gonna hurt very strong. Yeah, they're going to correct, like it's right there, but that doesn't make a crash. And I believe that gold sooner or later is going to accelerate, make the indices put back, then gold put back, and the indices rally. That's the way I see it, right? That's the way I see it. Let me kick off with the news. Gold short 10 from Ami, right? Another question. 1 second. Why do I think, as they say, why do I think that is transitory? Because the indices, HD, because the indices are bullish. And I believe that the indices won't, I believe that the indices won't crash, right? I believe that the indices, that they won't crash. So if the indices do not crash, that means overall, if there is no crash in the indices, that means overall that the rally in the commodities is going to happen. But it's a transitory thing, right? I make a lot of questions. Very good presentation. Thank you. I think Jason say that it's transitory. When the index is put back and correct 2020, the metals rally, yes, fixed. That's what I think. Go short 10. I invite you guys all to subscribe. We offer here a free trial, a 14-day trial. You can see our short 10 forecast there for $9.99. So, now we even have the Black Friday that is gonna be ending sometimes within the next 48, 72 hours. You get a month free. So if you like the presentation, you can subscribe and see our view for 2 months for the price of one. That's what you get. You can see Bitcoin. I don't forecast Bitcoin. Bitcoin is gonna follow the dollar. Fix. Bitcoin is gonna follow the dollar, and it's gonna do whatever the dollar. Honestly, it will do there, right? One more decline in the metals. Short 10 can be possible. Yes. What should happen to the interest rate? I think that they will be bouncing very soon. The knows at least. I don't know. I know a fundamental trader, SD. Right? I know a fundamental trader. All right. So that's our view, guys, about the inflation. I think it's gonna be transitory because of the indices, but I think it's gonna last because of the commodities. As always, I invite you guys all to take the 14-day trials here for $9.99. Or we have this beautiful promotion, which is buy 2 months for half, buy 2 months for the price of one. You can subscribe to it. Look at what Thomas say here, right? Honestly, we are different. Thank you. No, no, we are not perfect, HD. I know you've been around with us. We are not perfect. As you know, we are not perfect. Nobody is. A lot of people, a lot of people, a lot of people here, uh, a lot of people, SD, create force, a lot of people create false expectation to members, right? Membership side, like us. We are not perfect. You cannot subscribe to us believing that every chart is gonna be perfect. Now, something that I guarantee you, that a huge effort in our side, a huge effort in our side to be perfect, even though when we know that we are not perfect, and second, that you're gonna be in the right side most of the time, and third, that the blue boxes works 80 to 85% of the time. Not always, but you know, and you're gonna enter the market in areas and which you have the highest chances to succeed. That's the way I see it, right? So I hope you guys, most of you guys, take the advantage of the Black Friday, join us, or take the 14-day trials. You won't regret it. I guarantee you that, right? With the right state of mind, you won't regret it. Thank you guys all. I hope you enjoyed this seminar. Thank you for being around. Thank you.